In Kenya, there are mixed and very emotional reactions to President Uhuru Kenyatta's decision to approve a bill that effectively caps lending rates at no more than 400 basis points above the base rate set and published by the central bank. Now, one of those rates, the CBR, currently stands at 10.5%. Many Kenyans are excited by the possibility of getting access to credit at lower rates, but there are concerns about just how positive this change will be for the banking sector and for the average Kenyan as well. Maria Galang spoke to Habil Olaka. He's the CEO of the Kenya Bankers Association about the effect this law will have.
This has been seen as a popular but complicated move by President Kenyatta. What is your position on the law?
Our position is that we have seen the reason that were given by the President to assent to the bill and is quite aligned to our feelings as well. And so we accept the decision by the President, and we are aligning ourselves to ensure that we obey the law when it comes into effect.
Will existing loans be affected? For example, even mobile banking loans, will they also be affected by this?
The decision on whether the existing loans will be affected or not will be clarified once the law is operationalized. What we know is that clearly the loans going forward will be affected.
It's apparent that banking institutions are going to have to become a lot more innovative to make back profits when it comes to lending. What kind of innovations are we likely to see moving forward?
I'll also see banks leveraging more on technology. A number of the processes that are currently manual, expensive, generating unnecessary errors, and therefore having to rely on human judgment to be able to address those errors, will now see banks being pushed towards actually innovating and trying to come up with automated systems.
Banking institutions and lending institutions are likely to have less appetite for risk. What happens to the common man, low-income earners? How are they going to be able to access credit when at the moment it's difficult enough for them in the first place?
One of the challenges that we had identified was the fact that there was a lot of innovation that was currently ongoing in the banking sector to try to bring the members of the Kenyan community who are currently excluded from the formal services into the formal banking services. However, because of the fact that the risks tend to be also high, banks were then leveraging on that and charging a commensurate risk margin to be able to recover their investment. However, with the law coming into place, and given that effectively all products would have to be capped at that, we may see a reduction in the innovation and the investment by banks in such innovations, especially if you're not guaranteed to recover your investment.